Hi everyone, I'm Dr. Selvi, Professor, Department of MBA. Here I'm going to talk about financial management. Our learning objectives are to explain the nature of finance and its interaction with other management functions, to review the changing role of the financial manager and its position in the management hierarchy, to focus on the shareholders, wealth maximization principle as an operationally desirable finance decision criterion, to illustrate the organization of finance function. See here, before getting to the topic financial management. Financial management here is broadly concerned with the acquisition and use of funds by a business firm. The scope of financial management has grown in recent years, but it includes many business activities: production, management, marketing, finance, and human resource. Production. Production normally consists of, it starts from the raw material and ends with the final goods. So raw materials, it's when you buy the raw materials you may require funds, and when you process the raw materials you may require funds, and when you produce the raw material into final products you may require funds. And after production of funds you need to promote your products where it is available, then only the customers will buy your product. To promote your product also you may require funds. That's what marketing. And finance, without finance we cannot run the business. And regarding human resource, it starts with the recruitment and ends with the retirement. What about the functions to recruit the human resource and to run with the human resource? The fund is required. When we invest properly on the human resource, definitely we can extract good work from the human resource. For investment of human resource also we may require finance. So, what are the real and financial assets? Real assets are tangible or intangible. Tangible real assets are the physical assets that includes plant, machinery, office, factory, furniture, and building. Intangible real assets, it includes technical know-how, technological collaborations, patents, and copyrights. And talking about financial assets, these assets are also called securities. The securities are the financial papers or instruments such as shares, bonds, or debentures. And talking about equity and borrowed funds. So shares represents the ownership rights of their holders. Shareholders are the owners of the company. Shares can be of two types: equity shares and preference shares. Equity shares where uh, after debenture holders, after preference shareholders, they may entitle the dividend or their investment they can get back. Preference shareholders who has preferential right in case of receiving the dividends as well as receiving their own investment. Loans, bonds, or debts. So it represents the liability of the firm towards outsiders. The lenders are not the owners of the company. These provides interest tax shield. Equity and borrowed funds. Equity and preference shares, as I told you earlier, equity shares are also known as ordinary shares which do not have fixed rate of dividend. There is no legal obligations to pay dividends to equity shareholders. Preference shareholders have preference for their dividend payment over ordinary shareholders. See here, they get fixed rate of interest, I mean the dividend, and they also have the preferential right in case of repayment of their amount which they have invested at the time of liquidation. Then finance and management functions. All business activities involve acquisition and use of funds. Finance function makes money available to meet the cost of production and marketing operations. Financial policies are devised to fit production and marketing decisions of a firm in practice. So, what are the finance functions? Finance functions or decisions can be divided as follows: long term financial decisions, short term financial decisions. Long term financial decisions, where it includes the long-term asset mixed or investment decisions or capital budgeting decisions. What do you mean by this capital budgeting decision? Capital budgeting decisions where the company may have the capital, they have to invest their capital for their future purpose. Like if they want to invest any money in any kind of business or in a company, if they are investing in one company where the risk is high and where they have to, if if that particular company is not going well, then they have to face the risk. If they are diversifying the investment with some 2 3 companies, then they can minimize the risk also. And when we talk about capital budgeting, many alternatives may be available in the company where they will apply some technique to see that which company works well and which the budget, the investment makes you more money or makes beneficial. Accordingly, they'll analyze and they will select the best alternative which where they with the available alternatives. On the best selected alternatives, they will invest their money. That is what capital budgeting decisions. And capital mix or financing decisions, it consists of like capital structure. Capital structure means nothing but the debt equity mix of the company. How much debt a company should have to possess and how much capital they can raise in the share capital, the capital market. That talks about the capital structure of the company. Then the leverage decisions, like leverage decisions, we have financial leverage and operation leverage, and profit allocation or dividend decision. Dividend decision, normally they do have two decisions. Like one is declaring the dividend to the shareholders as and when they receive any earnings in the company. The other one is retained earnings. Retained earnings when the company has a good amount of investment opportunities, or if they want to run the business, or if they want to elaborate or extend, or they want to go for some new branch. So many things. If they want to go for some kind of other business to start, they can use the earnings of their own company, where they will, in such case, they will not declare dividend to the shareholders. The earnings will be retained in the company itself, and in future case, for that dividend also they may have some return over it. That is what dividend decision. And these things are considered as long-term financial decisions in the company. And when we talk about the short-term financial decisions, it is otherwise called liquidity decision or working capital management. So working capital management here, what do you mean by working capital? Working capital to run the day-to-day operations of the business, the company may require some capital called working capital. So if they manage properly, then they can run their production without have any interruption. That is what working capital management, where the gross, whatever the capital which they invest within a period of time, say for example 1 year, then that is considered as the gross working capital. When we compare the assets, current assets with the current liabilities, then that is called net working capital. So current assets, where we can invest any money in any kind of asset which will be there for 1 year period of time, that is current assets. So over and above the current liabilities which the company has as assets, then it is called that particular net is called net working capital. And liquidity decision, so if a company, a firm must able to fulfill its financial commitments at all point of time. In order to ensure the firm should maintain a sufficient money for their liquid assets. So liquidity decisions are concerned with both long-term and short-term financial decisions. Then talking about financial manager role. Raising of finance. The finance manager, he has to properly plan where the funds are available. So if they do know about the funds are available, the funds may be internally and externally. Internally, I told, like retained earnings, all those things, like wherever they are having reserves and surplus, the profits, all these things are available in the company itself as internal sources, and external sources where they can raise capital, the capital market, and they can go for some long-term debts from debenture holders or creditors. So, what are the sources available for the company to raise funds for their business? And after raising the funds, it should be allocated properly. So, allocation of funds, the use of funds. So, where and all it is required. We have seen the functional management of the business, like production, marketing, human resource. So, where and all the funds is required, accordingly, the funds to be allocated. And why we are raising funds, why we are allocating funds, why we are running the business, the main motive of the business is to earn profit. So without having any profit, we cannot run the business. So that profit should be planned properly. So profit planning should be done by the financial manager, and he has to understand the capital market where they can raise funds for their business. So these all comes under financial manager's role. And talking about financial goals, profit maximization, profit after tax, maximizing earnings per share, wealth maximization. What do you mean this profit maximization? So the basic objective of every business enterprise is the welfare of its owner. So it can be achieved by maximization of profits. Therefore, according to this particular goal, profit maximization, the financial decisions, investment, financing, dividend of a firm should be oriented to the maximization of profits. So that is, select those assets, projects and decisions which are profitable and reject those which are not profitable. So in other words, action that increase profits are to be undertaken and those that decrease profits are to be avoided. So profit maximization as an objective of financial management can be justified with some grounds, like he should be rational and he has to test off the business performance, the main source of inspiration and maximum social welfare, basis of decision making, all these things to be considered. And talking about the wealth maximization, so wealth maximization, the objective of profit maximization is not it's like vague and ambiguous, but it also ignores the two basic criteria of financial management, like risk and the time value of money. Therefore, the wealth maximization is taken as a basic objective of financial management, rather profit management. So it is also known as value maximization or net present value maximization. Here, wealth maximization means maximizing the net present value or the wealth or of a business, of a course of action. So it net present value is the difference between the gross present value of the benefits of that particular action and the amount of investment required to achieve those benefits. So the gross present value of a course of action is calculated by discounting or capitalizing its benefits at a rate which reflects their timings and uncertainty. So these are all considered as financial goals of the business. Then talking about, as I have explained about profit maximization, so maximizing the rupee income of business or the firm, resources are efficiently utilized, appropriate measure of firm's performance to be considered and serves interest of society also. So objectives of profit maximization, they consider it is a vague and it ignores the times of returns, it ignores risk and assumes perfect competition. In new business environment, profit maximization is regarded as unrealistic, difficult, inappropriate and immoral. And talking about maximizing profit after taxes or EPS. So maximizing EPS implies that the firm should make no dividend payment so long as funds can be invested at positive rate of return, such as a policy may be always work. So maximizing the profit after tax and EPS does not maximize the economic welfare of the owners. Shareholders' wealth maximization. So maximizing the net present value of a course of action to shareholders accounts for the timing and risk of the expected benefits. Benefits are measured in terms of cash flows. Fundamental objectives: maximizing the market value of firm's shares. These are considered as wealth maximization. And talking about risk return trade off. Financial decisions of a firm are guided by risk return trade off. So, the return and the risk relationship, where the return equal to risk free rate plus risk premium. So, risk free rate is a compensation for time and the risk premium for risk. So, risk and expected return move in tandem. The greater the risk, the greater the expected return. No risk, no return. And talking about the scope of financial management, like it talks about the human resource, the marketing part, the promotion part. And when we talk about the scope of the financial management, are like they have to see to that they are increasing the wealth of the shareholders, and they have to see to that